it's always important what you're investing in, but I think even more important is what you're not investing in and what you protect yourself from. And I can tell you the two areas that we are certainly underweight is office and retail. There's just been so many headwinds in those two sectors, and it's an area that we're not willing to make any bets.
Hello, everyone. Welcome to the Twin Shores Financial Freedom Podcast. In this podcast, we have a really good friend of mine, Allie Canavane, who comes from us from Apollo Global Management or Asset Management. This podcast is to share the insights that she and her firm are seeing from one of the top and largest private credit and private real estate firms in the world. Allie's been in the business a long time. We've been doing business with Allie for quite a long or a good amount of time. She's unbelievably knowledgeable, unbelievably energetic, and I think a lot of these insights will give a little bit of a look to what's on the inside from one of the largest asset management firms in the world. So enjoy, and thank you very much for your time.
Thank you all for having me here today. It's absolutely a pleasure to spend some time together. Yeah, just for a little background, I've been in the financial services for the last 15 years, really specializing in the alternative segment of the business. And over the last 10 plus years, it's been really real estate focused. So it has been where the majority of my career has been situated, and thrilled to be with Apollo, one of the largest alternative asset managers in the world. Just for a little background on Apollo, we actually manage about $550 billion in AUM. We are the largest alternative asset manager in credit. About $400 billion of that is in credit, and our real estate arm makes up, another $65 billion. So very, very large alternative asset manager that looks at opportunities kind of throughout the space, whether it's in real estate or credit, or other alternative options too.
That's awesome. So Allie, before you used to work for a firm, Griffin Capital, correct?
Good. Yes.
And then Apollo acquired Griffin. Can you maybe share a little bit about the difference between, working for someone like Griffin and then going into a massive firm like Apollo? Like,
Yeah.
what are the differences, and do you get, what do you see that's different?
Yeah, I would be happy to. It was a fantastic transaction that happened with Griffin and Apollo. They certainly were aligned in a lot of the ways the company operated, but it was a very different world being with a private, much smaller company, being Griffin, that did have an expertise specific to real estate as well. But really, Apollo saw it as a great way to be able to offer a lot of their institutional funds to the retail client. Something that Griffin had the relationships and had done a lot of work in that space. Historically, Apollo's been around since 1990, and they've only worked with institutional clients. So it's been the pension funds, the sovereign funds, and generally they have had a minimum of $10 million or more to get access to a lot of the alternatives that have been available. In the last decade, we've really seen this democratization of investments, and very specific to alternative investments as well. It used to be, especially alternatives, it was kind of this black magic. It was something where you would want access to what the institutions were doing, and there'd be at least a double layer of fees. You weren't really sure what you were getting. There wasn't transparency around pricing or valuations. And it was a challenge to try and truly incorporate alternatives into your portfolio. That is something that has drastically changed, and it's changed due to fund structure. It's changed due to regulations. It's changed due to companies like Apollo recognizing that the things that they do for the institutions are the same things that a lot of individual investors need as well. So it was a fantastic acquisition that Apollo made, so that they could bring to market a lot of these new institutional funds for the individual retail client. And one of the things specific to what Griffin was doing in the retail space is we actually had a fund. It was called the Institutional Access Real Estate Fund. Apollo loved that because it was hand in glove with what their mission was. It was getting access to institutional quality real estate, the exact same portfolios of real estate that the Ford Pension Fund or the New York City Employee Retirement System accessed, and allowing individual investors to invest right alongside them. So Apollo acquired Griffin, real estate fund transferred over as well, and all of Griffin Capital. And it's been a fantastic transition. I can tell you just the amount of information and research that comes out of the team is wonderful, but it's also comforting knowing you have the backing of a $550 billion asset manager at the end of the day.
No, that's awesome. What's been your favorite part so far?
It's the people. I mean, I think people and culture is what makes a business successful. And at Apollo, that is second to none. So it's been absolutely remarkable with just the talent, the expertise, the teams that, I get to work with on a daily basis now, that are just extremely impressive. And it's a phenomenal culture that encourages growth and invites everyone into the conversation. Whether you're an associate that just started with the firm or a partner, they want to hear from everyone. And I think getting all of those perspectives, getting all of that information is really important. And that's by far the best part, really, that culture.
So, Allie, we talk about this all the time because we've been in the alternative game since day one. We don't like to play the market game, especially as we're seeing it's the reality that it's a casino. I think is starting to come to the forefront, especially as we're seeing what's happening in the bond markets, which I believe are more important than the equity markets. We love real estate, and a lot of people love real estate, and we're even watching people wake up to this whole new world of, hey, maybe there's these investments out here. Can you share a little bit about why people should be thinking about alternative assets?
Yeah, I think now more than ever, it's a very timely conversation. You guys were ahead of the ball to be incorporating it into portfolios because 2022 was a really tough year. It was a dual bear market. So a traditional 60-40 portfolio didn't work. We saw both the equity and the bond piece of the portfolio got hit pretty significantly. And that was a tough pill to swallow for clients that hadn't been incorporating alternatives. And incorporating things that weren't correlated with the broader markets. And that's one of the things, especially in a downturn, all of a sudden everything moves together and you see that correlation is significant. So a lot of people now are turning to alternatives and looking for the differentiated sources of returns, differentiated sources of income. And real estate has been a really nice place to turn to, just as an asset class as a whole, because you look at real estate and what are you trying to get? It is something that's not correlated with the broader market. It's something that's going to reduce your overall volatility in general, depending on how you invest in the different sectors that you invest in as well. And something that's designed to be a great hedge for inflation as well. So it's a natural hedge to inflation, which obviously has been a very timely conversation. And it's something that is generating a consistent, really steady bond-like income stream that a lot of clients have been looking for to replace in that fixed income piece of the portfolio as well. So for all the reasons that we hated 2022, it's exactly why we like to have something like real estate and other alternatives in the portfolio.
Right. Right. And I just think about it when I did work with institutions and pensions. And then even when I worked at BlackRock on the institutional side, I don't think people realize like most of these pension funds and your, I guess, for lack of better term, smart money, only about 20% of their investments are in, things like equities and bonds and cash. Right. And I think it's only a matter of time before that started to come downstream.
Definitely. Yeah. And one of the challenges is that sometimes the time horizon doesn't work for individual investors, whereas, a pension or an institutional fund can lock up that capital for a very long period. And that's been a limitation. So a lot of investors would have to look to the public markets and something like a publicly traded REIT. Now that's still real estate at the end of the day, right? But the difference is you have a daily number and it's tied to the market and investor sentiment, which has its pros and its cons. And one of the cons is you're generally moving with the market. But why a lot of the institutions like private real estate is because you are getting something that is truly differentiated, is not correlated. So when we look at real estate, we kind of look at the full four quadrants of both public and private real estate and both debt and equity positions for those reasons, because they all act differently. And to your point, a lot of those characteristics are what the institutions and what the smart money, if you will, has liked about it over the last, decades of time. So it's a time tested strategy that has held up very nicely.
Yeah, and I just think of it, right, guys, like if you looked at the investments that have worked for 1,000+ years, it's real estate, it's insurance, and it's commodities like gold and silver and all that fun stuff, right? And I think it's kind of interesting how investors have seemed to really get away from some of those fundamentals, and now we're in the I think we're in the markets that are starting to demonstrate a return to those types of strategies and those things.
Yeah. And to your point, I mean, Parker Brothers made Monopoly in 1935. And how do you win? You go around, you buy real estate, commodities, utilities. It's one of those things where history doesn't repeat itself, but it sure does rhyme. Those are things that have held true and have been and really powerful in clients' portfolios today as well.
So, Allie, talk with us a little bit about Apollo and the real estate, the different sectors that you were just talking about, the segments, and what is Apollo seeing that's favorable now, and what are they shying away from?
Yeah, I think it's always important what you're investing in, but I think even more important is what you're not investing in and what you protect yourself from. And I can tell you the two areas that we are certainly underweight is office and retail. There's just been so many headwinds in those two sectors, and it's an area that we're not willing to make any bets. There's so much uncertainty specific to office. Over the last 3 years since the pandemic, there's been a lot of questions as to what it's going to look like in this new world, this new environment. And it's something where we still really don't know. And the numbers are starting to come out as those leases start to roll. So we've seen a lot of employers that have continued to pay that rent for an office building that might be 20, 30, 50% occupied. Well, when that lease comes due, are they going to re-sign it? And we're seeing a lot of those tenants ultimately decide not to. So whether it's, we go back to work part-time, we go back to work full-time, we make everyone who is in a 30-mile radius come into the office, unless you're that client-facing type of position where you need to get into the office to do your work, we're just not seeing the same numbers that we have historically. And so for those reasons, we're waiting to see how that settles. And I'm sure there will be a time, years from now where it is attractive to us yet again, because that's one of the big things is that the sector performance within real estate, it's not the same year over year. It's very different. And actually, if you look back, to early 2000s through even like 2015, retail was actually one of the top performing sectors within real estate. It was a great place to be, a great place to own. But obviously, due to the shift to e-commerce, that has become very challenged. So it's also an area that we are not leaning into, we're not investing in right now. And what we're seeing within the retail space in particular is, a lot of those properties are being repurposed, whether it's medical, where you have lots of parking and so it fits for something along those lines, or if it's just shifting to more of a distribution warehouse facility. It's just no longer a demand for those regional malls. If you look at retail and what's going to do well, it almost has to have that Instagram worthy aspect to it, right? So my niece or nephew would be somewhere and actually post it. It's like, oh, all right, that's a cool place to be, right? And that's a decent retail property. But the majority of malls and things are not falling into that category. The one area that is still kind of a bright spot when it comes to retail that we like is grocery anchored, having grocery store, even the ability to order groceries online. You still have the pickup now. And so there's certainly still a bright spot when it comes to the grocery anchored. So I'd say those are certainly the areas that we are staying away from and are pretty de minimis when you look at our portfolio and where we're invested today. The areas that we like, and one area has been kind of tried and true, is multifamily or apartments, as a lot of people refer to it as well. When we're investing in real estate, we're really looking at core Class A real estate. So kind of the cream of the crop. You're in your primary, maybe a secondary market, but you're not in the tertiary or the value add space. So when we talk about multifamily, we're talking about the 100 to 200 unit buildings that are right in the city center, right outside that city center where people can commute in pretty easily. And what we've seen within multifamily is it's just been a consistent performer. It's really been a resilient asset class because it is shelter at the end of the day. And it's turned into shelter and office and a whole host of other things, your gym, and throughout the pandemic. So it's held up really well. And it continues to do so as we see volatile markets. One of the other big drivers behind our conviction for multifamily is just the supply demand imbalance. There are not enough apartments out there for people that are looking for them, which is crazy. And that's being driven by a whole host of things. The challenging environment to buy a house, for example, your home prices are exceptionally high. And now you pair with that a very high interest rate for your mortgage. It makes it really challenging. So a lot of people are saying, hey, maybe I'll just hold on, save for another year or two, and then ultimately move out of this apartment. And the other thing that's also driving it and keeping the supply low is just, if we are in an inflationary environment, it means that goods cost more. And so it's one of those things where, hey, if the materials to build that apartment building just got more expensive, then that's a challenging environment to put more construction up. So we've seen kind of the slowdown in supply and things that are coming online. The crazy thing is we probably even have more demand coming. Throughout the pandemic in 2020, we actually had 52% of people that were 18 to 29 living at home. Not everyone wants to be living in mom and dad's basement or at home.
Mom and dad doesn't want the child in the basement.
Hey man, it saves you money. It saves you money. I don't have to
Come on.
I don't have to pay for groceries, no cable internet, no mortgage or rent. It saved me a lot of money.
Yeah. There are some bright spots, right?
Alex is looking to move back.
Yeah, I would love to. I would love to. Save me some money.
Yeah. Seriously. But hey, you made it out, and a lot of people are finally doing that as well. So I mean, it was crazy. That was the highest number since the Great Depression. People living at home. So now as people reemerge and say, I got to get my own place, we see this increased demand as well from multifamily.
You don't see rents going up for these apartments? Like I don't know. I think it's like some of these rents is for a 2-bedroom, and I have a 3-bedroom house as much as my mortgage on some of these properties. Like to me, it doesn't seem viable to even rent then.
It does make it more challenging, but comparatively to buying a house, it's still significant.
Correct. Yes. No taxes and no insurance and so forth.
No 20% down payment, a whole host that go into it. So, if you have the option, right, you can put it towards a mortgage payment, great. But a lot of people simply don't have that option or aren't there yet. But, coming from maybe a landlord's perspective opposed from a renter's perspective, I know we've all been there, but especially in an inflationary environment, if the costs are going up, it's something that they're able to pass through to the underlying tenants as well. And so by having multifamily, for example, with an annual lease, you have that ability to keep up in an inflationary environment. And so that's one of the nice things about owning real estate and being able to invest in real estate. You get to be on the other side of things. So not just upset that your rent's going up yet again.
Do you see tenants tend to leave when that happens? right? Like if you have, say this year it's 2,500 and the next year you're going to raise it to, due to inflation, to 27 or 3,000. Do you see an outflow of tenants leaving or anything?
So where are they going to go?
Uh,
Right.
You got a good point. I don't know that. Yeah.
There lies the challenge. So if that's market rate for the rents, and we do see kind of the industry averages, right? There's certain pockets, certain areas where they'll go up a bit higher, but unless you're looking to move, which a lot of people did, right? A lot of people relocated throughout the pandemic. You have the ability to work from home. And hey, I don't want to be living in downtown Manhattan paying these crazy rents when I can move down to the Sun Belt and, have a great quality of life and pay half of what I was paying for rent. So we certainly saw a lot of that happen. But if you're in the market that you want to be in, a lot of the times you don't have a choice, or you're looking at number one, moving costs, and then paying a very similar rent to what you were paying already. And the crazy thing is within multifamily, if you look at the occupancy levels, it's been over 95% pretty consistently. And that's really healthy for just in general in multifamily. So it's been exceptionally high. So you haven't seen, vacancies tick up or anything.
And then, Allie, are you still seeing a lot of migration, like we've always been hearing for the past 2 years since COVID, the migration from, different places like California, New York, New England, et cetera, down south?
We certainly are seeing it. It's definitely driven by more of the business friendly states too, because when you look at where population growth is, you also see a lot of job growth. So it's not necessarily just people who are working remote, but rather moving to the Austins and working for, the Apples, the Teslas, a lot of the companies that have moved corporate headquarters to some of those other cities that are more business friendly at the end of the day. So it has been something we're still really getting and digesting the data from the 2020 census, which is pointing to some areas like Orlando, for example. That was supposed to do well. It looks like it did even better than it was anticipated. So we certainly have seen that. We've seen a lot of people moving out of those markets.
Everybody wants to be close to Mickey.
Yeah, exactly. Yeah. Hit up Disney on your lunch hour.
Right. Yeah. Talk about rents going up. Go shop there, take your kids.
Oh.
So, Allie, go back to something you mentioned before, because I'm not sure if people are aware of this or not, because we talked a little bit about this on one of our biweekly updates that we do. And we're talking about, the commercial real estate in the office space could potentially be a $20 trillion problem. And it's because of the rollover that's about to happen. Can you just share a little bit more information on that and what that means for people in office space?
Yeah, it's certainly a challenge. And you have these office buildings that suddenly are finding themselves pretty vacant. And office is also a funny area, because even pre-pandemic, going back 25 years ago, when you looked at office, the way people underwrote it is they always expected and anticipated occupancy to be higher than it was. They expected it to be 90 plus, when on average it actually worked out to high 80s. And they also expected the cost to be less when it comes to capital expenditures to maintain an office building that people would want to work at. So you always had some challenges within office, but obviously the challenges have come to the forefront post-pandemic. So now what's happening is you end up with these office buildings that have debt coming due. And simply put, that debt, that capital that is owed on the building is more than what the building is now worth. And it puts a lot of managers in a challenging situation if they've been owning office, and that's, the one area that they've been investing in. You're going to see some pain. And so that's, another reason that we are not putting any money into office, why we're not allocated to it, because I don't think it's going to be pretty. I think it's going to be challenged. And it will be interesting, again, just like with the regional malls and repurposing some of those properties. Hey, what do we just talk about we're short of, right? Apartments. So there's the idea that in some of these major markets, you can repurpose it for apartment buildings. It's costly to do so, but maybe there might be some government grants or something along those lines, where they can kind of salvage some of these buildings that have quickly become pretty vacant.
Wow. Yeah, and we were talking about that a little bit too, right? Because not only do you have the issue with, okay, they have to roll over this lease and now refinance at a higher rate, but then you just added to it, like there's a numbers issue going in and assumptions that were wrong. And then at the same time, what happens if you can't repurpose that building because of structure, right? You throw in walls and plumbing and bathrooms. I mean, this seems like a really, really big problem that's about to start hitting.
Yes, definitely. And to my point prior, we're starting to see it because you have to remember in office leases tend to be longer term. So generally that 5, 7, 10-year time frame. And now every office lease wasn't signed at the same time. So as they start to roll, that's really when we're going to get that clear picture of how this is going to play out and what's going to happen in that space. So it will be a challenge, to say the least.
That's interesting. Yeah, it was funny. I saw a stat the other day that talked about cell phone usage in major areas. So, for example, like in Boston, the cell phone usage is at 51% of what it was before COVID, which a lot of that has to do with, people being in the office. And you look at the numbers of that, New York, Washington, San Francisco, Atlanta, et cetera, et cetera. I mean, there are some alarming numbers that are starting to pop up where, we look at it, we're like, wow, we just can't believe this might be as bad as what the numbers are starting to show.
Yeah. Yeah. No, wholeheartedly agree. And I think it's really important too when you're thinking about investing in real estate too. And a lot of people do it on their own, right? Direct ownership. They say, hey, I'm going to buy that 3-unit office building in a secondary or tertiary market. And they find themselves in a challenging situation. I mean, to have the flexibility and to be able to rotate in and out of sectors, is also something that can be a challenge in real estate in particular, because you recognize that things aren't always in favor. And that's been something that, we've been able to do exceptionally well. And it's been so important because not all real estate is created equal. And I think we're seeing that play out, to your point, with office. And so to be able to kind of pivot and adjust the portfolio in a meaningful manner is more important now than ever.
Yep. And Allie, what about, not just domestic, but international? Are there trends you're seeing where it's like, hey, the US is looking good in some spots and we're looking international in others, or what's Apollo seeing today?
Yeah, we primarily invest when it comes to real estate domestically, simply for the fact the cost of hedging. So you have to have, a pretty compelling argument for investing internationally to cover your cost of hedging just for changes in currency. But there certainly are opportunities, both in Europe and the Asia market as well, that we have boots on the ground over there and that are kind of diving into that. I will tell you one area coming from, really the Apollo background, that we are looking to be the lender of choice, and that's specific even to real estate debt. So as long as it's the right asset, right, and it's not that office building in the tertiary market, we do want to be able to step in and be that lender of choice for a lot of these banks that are handcuffed, that are no longer able to make those loans.
So it sounds like Apollo's almost becoming its own bank now too.
Yeah, it's something where on the credit side, we've always had that ability. And the nice thing is our unlike banks, our liabilities are long-term as well. So it works out really nicely that we can kind of marry the two together with our lending capabilities on the real estate and the credit side across the board.
Awesome. Well, since we're talking about credit, why don't we shift to the credit markets? So I know they're a hot topic these days. That's all they're talking about, left and right. So why don't we do this? first of all, can you please explain why the credit markets are important to everyday people and everyday investors? And then maybe let's talk about this liquidity and potential credit crisis that we're looking at on the horizon.
Yeah, definitely. Credit is a piece that everyone should probably have access to in some way, shape, or form within their portfolio. Different ways to access it. Again, both public and private markets are going to have different characteristics. But it's something that, again, can be a really great differentiated source of return for investors at the end of the day. And one of the nice things is through a lot of credit strategy, you can take away things like interest rate risk, right? So that duration risk that you run into with your traditional bond portfolio, for example, can be quite a challenge, especially in the environment that we're living through right now, as we've seen rates kind of take off over the last 12 months. What the nice thing you can do within the credit markets as a whole is generate a really healthy income component. And I will say, in today's environment, the credit teams are pretty giddy. We're seeing base rates exceptionally high, and the returns, they're in the teens opposed to just 12 months ago where you were single digit. So it's significantly better. And we're in an environment too where a lot of credit is stealing from equities right now, just because of the expectation of returns that you can get out of the credit markets. When looking at the equity market, you are getting maybe some low growth and continued volatility. So it has been an area that people are leaning into to be able to take advantage of some of the opportunities that we're seeing today.
Oh, that's awesome. So what does the future of the credit markets look like over the next maybe 6 to 12 months? Is there going to be a liquidity and credit crisis that we're all going to be looking at, or is this going to be one of those things where, yeah, maybe we have an issue, but it's temporary, and those that have the capital on the sidelines and are ready to go can capitalize on it?
Right. I definitely think there's an opportunity to the latter point for sure. I think it's an environment where banks are going to be a little bit more stringent when it comes to their lending standards. So it will become a bit more challenging for a lot of those companies that historically have had no issue. But as we've seen, that space has just grown for your non-traditional banks to step in to be the lenders. For example, we historically, even just in the last 10 years, there was a ton of opportunity within the middle market, and middle market being companies with EBITDA of, 25 to 75 million or so. So cash flowing somewhere in that 25 to 75 million. And reason being is that Dodd-Frank came out. So regulatory standards made it more challenging for banks to lend to a lot of these companies. So what happened? A lot of private sponsors stepped in to provide that capital. That space has since gotten pretty crowded. It was a great space to be in. Apollo has done a lot within the middle market, but really where we see the opportunity today and where the white space is even lending to those large cap companies. So looking at companies that are cash flowing over 100 million, that has really opened up. And especially with lending standards, with some of the stipulation that banks put in place, right? It can only be a 1-year loan. Well, what if a company wants their capital and their lending to match their the business plan and the financing? You can structure deals differently by going outside of your traditional banks. So I do think for people sitting on cash that have the ability to step in and be that lender of choice, it's been a great opportunity for us. And it's certainly been at Apollo, we're ready and willing for the right companies. The thing that you have to take into account is, I mentioned, you have a great hedge for interest rate, right? You have a duration of, under 2 years or 1 year and change for a lot of what we do, or it will be floating rate in nature. So you have a great natural hedge for a rising interest rate environment, but you are taking on credit risk. So it comes down to the due diligence and the underwriting of that sponsor who's making that loan. So, what's really important is that you feel comfortable with the track record, the history of the company in that space, and you feel comfortable that there won't be defaults. Because if we are in this situation with rates going up, number one, that company has to be able to pay the higher rate in order to get access to the capital. And number two, as we see continued volatility, the economic backdrop, you have to be comfortable knowing that you are lending to the right companies too, which is really important.
Right. And I don't think even with, you look at real estate and traditional financing, I don't think people realize that traditional financing, 20% down in 30-year, 15-year, whatever adjustable rate is, that's not the only option to secure financing, right? There's that traditional public financing, and then there's private financing, which is completely different. And a lot of the times it has a lot less requirements, and it's an easier process to go through than the traditional financing side.
Definitely. Yeah, it's something where you see it just fits the business model for a lot of companies much better than even going through the public markets, or even if it's speed, right? If they know they need that capital for an acquisition, whatever it might be, if it's a company we've worked with, we've already done the due diligence, we can step in pretty quickly and provide that. And it's been really interesting. I would say 5 years ago, it was certainly a borrower's market, right? Where you could get some covenant-like deals. You had pretty good terms as the borrower. And today that has just flip-flopped, where it's certainly a lender's market where you can be pretty rigorous about, requirements, but still have, the speed of execution and have structurally be really creative. And, that's something at Apollo that we certainly look at is we'll trade complexity for price, right? So we will take something that is overly complicated that wouldn't suit a traditional bank or any other source, and we'll be that lender for those reasons. So it's it's been really interesting with credit markets, at least.
Yeah. I mean, even look at what Apple is now issuing a credit card.
Yes, I saw that.
Well, they've had a credit card, right? They raised their interest payment for their accounts to 4.75. Yeah, for cash.
Anyone else think there's not an issue with traditional banking in this country?
But who did they go through? They use Goldman, or is it Schwab?
I think it's Goldman.
Okay. So Goldman's their bank, or is the bank technically, right, for them?
Yeah, but even Goldman's not a traditional bank. Speaking of Goldman, Allie, you probably know a little bit about Goldman. They just play a different game than everybody else, don't they?
They do. I mean, they're certainly one of the biggest that are out there. And it's crazy. I will say that there is just an interconnected world within the financial system as well. So, some of, even at the Apollo level, if there are different lenders in the space, we generally talk to each other and take deals down together more than I think a lot of people realize, and think that, hey, that's a competitor or something along those lines. And it's more so, it's, hey, we do business with them. Those are the companies that we like. So, yeah.
I remember at BlackRocker, because I was on the iShare side and they took us over and we were putting ETFs and 401ks. And we kind of smartened up at one point. We're like, well, instead of fighting the battle of trying to get these things on the platforms, because they don't want to do it because of the revenue sharing, why don't we just put our ETFs in JP Morgan's target date funds? and JP Morgan was like, absolutely, let's go. So 35% of every dollar that JP Morgan sold went to us.
Wow. Yeah.
But I don't think people do understand that. Like, there's a lot of competition on Wall Street and between financial firms, especially when you get into the larger firms, because it allows you to do some very, very creative things in taking down some pretty big deals together.
Exactly.
So I have a quick question. So something that we talk a lot about on both this podcast and on our market updates is diversification, and how the traditional diversification of asset allocations, bonds, stocks is kind of slowly dying off. And we've talked about credit markets and real estate, commercial real estate. And how would you think that someone who's on the younger side, who might not have a lot to invest but wants to diversify, where would they put their money in regards to the credit markets and commercial real estate?
I think within commercial real estate, it's a time-tested strategy. So it can be a piece of your portfolio for the long run, right? It's almost like stock, bonds, real estate, or alternatives is the new composition because it will give you a differentiated source of return, but it will also kind of smooth out the ride too and take away some of those big swings. So if there's different ways to invest, right? So if you need daily liquidity, which you need access to the capital, you think you're going to buy a house in the next year, then that might be the case. And you might have to access it through the publicly traded REIT market. But if you have a little bit more of a time frame where you can say quarterly liquidity or annual liquidity, then you can certainly start accessing more of the private real estate market, which is going to give you more of that differentiated source of return than just the broad-based publicly traded REIT market as a whole. So there's different strategies that you can access that. And, we even implement both public and private real estate into how we invest in real estate, kind of looking at a comprehensive solution. And then there's the pure play, hey, be a landlord, right? Buy your own 3-family and have an apartment building and rent that out. That's a very taxing and challenging for a lot of people, but it just depends on, your ability to access it for liquidity purposes, as well as the labor intensive, how much work you want to put into it at the end of the day.
And I don't think, and Alan, maybe you could share this or correct me where I'm wrong. I don't think a lot of people understand how to access this type of stuff. And then part two is that they don't necessarily have access to it, right? You're not going to go to fidelity.com, vanguard.com and have access to these strategies. But I don't think there are direct ways, which are pooled, right? Direct participation programs. And then there are something called interval funds, which operate like mutual funds, but they're not publicly traded like publicly traded REITs, right?
Yeah. Yeah. Interval funds have been a fantastic wrapper for a lot of these investments. And really the main reason is the limitation around a mutual fund, for example. You can only have 15% of a mutual fund in illiquid investments. So you're not going to have the ability to incorporate something like private real estate into a traditional mutual fund because it's not liquid like a mutual fund has to be. Whereas an interval fund provides liquidity on an interval basis. So most are quarterly, some are annually or whatever it might be, but generally interval funds will give you quarterly liquidity instead of daily liquidity. And they'll have some parameters around that liquidity where it's only 5% at the fund level on a quarterly basis. And what that does is it protects the portfolio. It allows the fund to invest into illiquid investments. And it allows the managers to be in a position where they're never a forced seller. So if there's a run on the bank, it's prorated and every client gets a piece of that and then can go in the next quarter. And really, if you ask any mutual fund manager, they wish they had something like that. Unfortunately, they have to sit in cash or sit in something very liquid that generally won't give them the return that they'd be able to generate if they had some parameters around liquidity. And that's really where you start to see the illiquidity premium come into play, where you are rewarded and paid for tying up that capital for more than a day, whether it be that quarter or a year or whatever fund. But it's just been a better mousetrap at the end of the day when you're trying to get access to less liquid markets, because the old way was daily liquidity or no liquidity. And this is just a really happy medium where you're getting quarterly liquidity and you're accessing institutional quality investments that are less liquid.
Right. And it doesn't, like you said, it doesn't have the problem like in the publicly traded REITs. You can get a run on the REIT and that strategy's gone. And if mutual fund business, 2 bad quarters and all the 401ks pull their money out, that strategy's gone. And then at the same time, you do have to, as an investor, right? You have to take into account liquidity. Like these aren't strategies that you're tunning into, right? And you should never ton into something, but this is a 5, maybe 10% allocation, not 30, 35, 45, 55.
Yes. Yeah, exactly. It's a piece of the portfolio, especially something with limited liquidity like that. You have to be comfortable that you have access to other cash and other liquid investments too, excluding that piece of the portfolio. But yeah, we see, and generally, if you look at a portfolio allocation, you can see that target range anywhere from 3, 5, 7, 10%, what makes sense for that client, what they're trying to do with that capital. The other nice thing, especially with both real estate and credit, is that you do have a heavy source of income. So for the pre-retirees that are looking to really differentiate the return and diversify the portfolio, it can be a really nice place to be. And you can choose to just simply reinvest and then turn the income on in a year, 2 years, 5 years, whenever it is that you need to start tapping into that income or start using it. So it kind of works nicely.
Right. Yeah. And that's one of the reasons we love it too, because it's that 5.5%, 6%. I mean, your bank's never going to touch that. And quite frankly, the bond markets aren't touching that right now either.
Yeah, crazy. And one of the things about real estate too, especially for your taxable dollars, your non-qualified accounts, is that it's tax favored income. So it's not about what you make, but what you keep. And so if you can pass along the depreciation and the amortization of the underlying real estate, what that ultimately does is give you really tax favored income. So you don't have to pay taxes on the full distribution that you're getting from the underlying real estate, which can be extremely powerful as well when you look at it at a tax equivalent basis.
We're all about tax favorite stuff over here, favored stuff.
Yes.
So I saw something last week. The average American will pay over $410,000 in taxes in their lifetime.
Yikes.
Isn't that insane?
Yeah. Yeah. So look at real estate.
Right.
What
Don't cut out your Starbucks and Dunkin' Donuts. Cut out Uncle Sammy.
Oh my goodness. Yeah. Let's get tax smart, right?
Right.
I was reading with the Biden or someone wants to pass a new law where good credit scores will get a 1 point something percent and lower credit scores will not. How will that affect the commercial real estate aspect of it?
Yeah. And I saw that as well, but I'm not sure if that's just, it can be or just homeowners. It doesn't fall into commercial real estate.
Okay.
But it's an interesting thing, which if I don't know how that would work. I guess it wouldn't work in commercial real estate, but yeah, it's fascinating to see. how it's going.
What about over the past year, like BlackRock and other big institutions withholding people from withdrawing out of the REITs?
Yeah. Honestly, the fund's doing what it's designed to do, right? It's protecting that portfolio. So if you have 20% of investors trying to get out, well, the 80% that aren't are being protected by prorating some of that. And in a way, they're a victim of their own success because specific to like BREIT, Blackstone, for example, they've done a really nice job. They've had really strong performance. Real estate as a whole has had strong performance in a volatile market, especially last year where it was up. And a lot of people went and said, all right, let's rebalance our portfolio. Well, what's done really well, the real estate piece, what was a 5% allocation is suddenly 10, and you got to trim that. That means you need to redeem it. So they saw certainly higher redemption requests. Fortunately, we haven't fallen into that category, which is great as of late. But it's something where, again, you have to be comfortable with limited liquidity. So in a worst case scenario, if it is prorated, if you're getting a portion out and not all of what you requested, you still have other places that you can go to tap into that liquidity. But I think it's just a matter of looking at, what's been doing well, matter of rebalancing, and a matter of the outlook for, private real estate in particular. We're much more bullish on publicly traded REITs right now, for example, because they sold off so significantly last year. They were down 24 and change. They sold off worse than the S&P. So it created an attractive buying opportunity into publicly traded REITs, whereas private real estate was actually still up last year. So to be able to have kind of that full scale and fully diversified investment thesis has been really important too, because you can look at relative value and tap into some of those other markets, even for real estate as a sector.
Right. And I don't think a lot of people understand, like, when you're working on things like 401ks and pensions and endowment funds, like, you have an investment policy statement and constraints that you have to operate in accordance to, right? So, like, for example, I was talking about this with a friend of mine a couple of weeks ago while we are in Florida. And he's on the board of a very, very large pension fund in New York, and they did an allocation to natural resources. It made, 9.5%. And then they're in front of the compliance committee being told, hey, you got to cut the allocation back because it's too risky. Right. So similar things can happen with these types of investment strategies, which I think goes to the point that you just said with the Blackstone strategy. Like, it's more of a compliance mandate than something's wrong.
What happens when the compliance, like, they do that and then they can't pull the money out due to what's happening at, like, Blackstone? They halt it or whatever due to compliance. Do they make you, like, you know what I mean? Are they going to make you sell it, or do you have to hold on to it even though you're not allowed to pull out now?
Yeah, I think depends on what the investment policy says, because it should be stated in the guidelines.
Okay. Interesting.
Yeah, those are very interesting. So, Allie, if you had any recommendations or things to think about for anyone who's listening into this podcast about real estate credit and the opportunities that you're seeing, or just general investing, what would that be?
Well, I think you kind of hit it on the onset here. It's incorporate alternatives. Look for something that's going to give you that additional return per unit of risk, and something that's truly not correlated with the broader market. I mean, now we see more than everything moving together. So you really need that piece of the portfolio where you can incorporate things like private credit, you can incorporate things like private real estate. You can incorporate a lot of these other investments that will be really powerful, especially in volatility, especially in a low growth environment. A lot of the things that we're running into within the next 12 months or so. And just be very cognizant about the managers and the sponsors that you choose to work with. Do your due diligence there to make sure that you're comfortable with the company that is taking your capital and taking care of your capital as well.
Right. I don't think people understand the amount of homework and research we do on these things.
Exactly.
So, gentlemen, any other questions for Allie?
I've got one. Speaking of alternatives, Allie, I noticed on your website Apollo does a lot with retirement services. What's this company? Athene? I don't know how you pronounce it. With Athene and Apollo, right? How do you guys work together and help clients with investing in alternatives in their retirement portfolio? So my question was, with alternatives and Apollo working with retirement products, why do you think investors should consider alternatives in their retirement portfolio specifically?
Certainly, retirement services, and Athene is an insurance company as well that Apollo owns. Really looking at retirement services, so primarily looking at fixed annuities and things that actually have guarantees. And I think it just speaks to the diversification within the portfolio and being able, especially as you get closer to retirement, as you are withdrawing from those portfolios, things like sequence of returns are really important. If you start taking your income out in a down year, how detrimental that can be compared to, if you're experiencing a nice bull run. So having something that can help protect from the downside is also very important. And that's a lot of what, we do at Apollo and Athene.
Income producing alternatives can really help with retirement income for people. No, we were just saying, like, income producing alternatives can help really with the cash flow and the income needs for retirees and help manage that sequence of return risk and market risk. So, I definitely think there's a plug there. So, Cam, or anything else that you can think about for today?
I don't think so.
All right, let's close this thing out.
Alrighty then.
Guys, it was a pleasure.
Yeah, thanks for coming on.
Yeah. Well, on behalf of Twin Shores Financial, thank you all for tuning in. If you enjoyed the podcast episode and want to continue learning how you can become a financially free individual, please tune in next week for another episode. Don't forget to like, share, and subscribe and follow us on all of our social media platforms. If you're listening on Spotify or Apple Music, please don't forget to follow us. And if you're watching us on YouTube, please subscribe. Anyone have any last words?
Do your homework, invest wisely.
Well, thank you so much, Ali, for coming on.
Yeah, thanks, Allie. Thanks for coming on.
Thank you.
Well, thanks.
Thank you.